Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing why this AI Capex cycle isn't slowing down. It's now almost been 2 years since ChatGPT was introduced to the world, igniting an AI-fueled rally that is still continuing. We thought it would be a good time to check in on the industry and have a look at the winners, losers, and those still building for the future, which, to be honest, is most of them. Plus, we'll discuss why periods of heavy Capex can provide great opportunities. Also, while the US election was just a few days ago, we're going to do a deep dive on it next week and what it means for investors. Before we dive into what happened in markets this week though, here's our quote of the week from Geoffrey Hinton. Early AI was mainly based on logic. You're trying to make computers that reason like people. The second route is from biology. You're trying to make computers that can perceive and act and adapt like animals. Now, let's dive in. Here's a quick summary of what's been going on. First up from Reuters, markets lean towards Trump trades as election results start to trickle in. What's our take on this news? It didn't take the market long to react to Donald Trump's re-election. News that the election was being called in the Republicans' favor triggered a surge in the US dollar and stock futures. The S&P 500 rose 1.7% and the Russell 2000 closed 4.4% higher as investors placed optimistic bets on the potential for lower taxes. It seems that investors were more encouraged by possible reductions in taxes than they were dissuaded by the likelihood of rates staying higher for longer. While the market reacted positively, analysts were more concerned, flagging issues with Trump's proposed economic policies. In particular, analysts took issue with his intentions to implement widespread tariffs placed on US trade partners. The impacts here could be quite multifaceted. Tariffs would undoubtedly have an inflationary effect on the US economy and restrict the Fed's ability to lower rates in the future. But it's also likely that trade relations will be negatively impacted. The impacts could differ on a sector-by-sector basis. The financials and energy sectors would benefit from the tax cuts and some deregulation. Other sectors that have greater exposure to international trade could struggle if additional tariffs are placed on imports. Uncertainty seems to be an apt description on how things are likely to play out over the next 4 years. Next up from CNN, Berkshire's cash soars to $325 billion as Buffett trims Apple and Bank of America shares, while operating profits fall. What's our take on this news? Buffett's clearly not done building up his financial fortress. In Q3, Berkshire further reduced its stake in Apple and Bank of America. It has now sold more than $120 billion worth of Apple stock in 2024 alone, yet the company is still its biggest holding. The company's quarterly operating profits declined 6% due to underwriting losses from Hurricane Helen and a strengthening of the US dollar. Thankfully, Berkshire Energy, Burlington Northern Santa Fe, and Geico all reported improved profitability to somewhat offset this. Berkshire has been a net seller of stocks for 8 quarters now, and he is not even buying his own stock back. So clearly, he thinks the market's valuations are still too high. Next up from the Financial Times, chipmaker TSMC is hit by Taiwan's soaring energy prices and growing outages. What's our take on this news? Taiwan's cheap power is no longer one of its competitive advantages. Taiwan Power Company, a state-owned utility company, has had to deal with increasing losses over the last 2 years. Russia's invasion of Ukraine caused a surge in global fossil fuel prices, and the lack of alternatives meant that the power companies struggled to pay the increasing bills, despite increasing power prices 4 times since 2022. Industrials are copping the brunt of the energy price increases compared to households. However, TSMC only expects a 1 percentage point impact on its gross margins. Companies in Taiwan need predictable power to plan long-term investments, and being at the mercy of government policy and volatile imported energy makes that increasingly difficult. Next up from Barron's, luxury goods slump catches up with Ferrari. What's our take on this news? Their F1 team is on the rise, but the same can't be said for Ferrari's share price. Ferrari's stock slipped 5.4% on Tuesday despite reporting better than expected results for Q3. While the results said one thing, investors were undoubtedly concerned by a decrease in car shipments and weakened demand in China. Ferrari's adjusted earnings rose 12.5% compared to last year, but shipments came in below the mark. Total car shipments fell 2% to 3,383 units, which isn't anything significant, but the more worrying figure is that shipments to mainland China, Hong Kong, and Taiwan dropped by 29%. China's post-COVID recovery has been a little sluggish, which has dragged down consumption on luxury goods in the region. Because of how popular luxury brands are in China, this is expected to weigh heavily on the sector's earnings. Ferrari's new Halo car, the F80, is due to begin shipping in late 2025, and the market was quite optimistic following the announcement of the car. We'll have to check in a year from now, as there's a possibility that the $3.9 million price tag and the V6 powertrain could fail to land with consumers expecting a passionate V12 sound for that amount of money. Next up from S&P Global. 5 US REITs suspend dividends amid 2024 cuts. What's our take on this news? Stock prices often give up far more than the yield when dividends are cut. 5 US REITs have suspended dividend payments in 2024, while 6 have reduced their dividends. There are over 160 listed REITs in the US, so the percentage cutting distributions is still pretty low. Most of the companies cutting dividends are very small and mostly in the retail, office, hotel, and diversified segments. These cuts were anticipated too, so the impact on stock prices was relatively limited. The sustainability of dividends is a crucial factor to consider before you invest in any company, including REITs. Yields of 5 to 10% can be tempting, but the stock price can fall 2 or 3 times that if the dividend gets cut. Some companies really are profitable enough to pay generous dividends, but others are forced to offer high yields to attract investments. It's important to figure out why the yield is what it is. And lastly, from CNBC, Federal Reserve cuts interest rates by 1/4 point. What's our take on this news? There's some relief in sight for homeowners, but as Chubby Checker said, how low can you go? The US Federal Reserve approved its second consecutive interest rate cut overnight, lowering the benchmark borrowing rate by a further 25 basis points to a target range of 4.5% to 4.75%. The decision was unanimous as officials emphasized the importance of supporting employment targets while still trying to keep inflation under control. The latest cut was well received by the market, with the Nasdaq up 1.5% and the S&P 500 closing at record highs following the news. Treasury yields fell after the interest rate decision, further indicating optimism amongst investors. While the Fed was clear-cut in its justification of the rate cut, mixed economic signals spark a bit of uncertainty. While GDP growth for the third quarter was slightly below expectations, the macroeconomy has still been posting solid growth. With inflation still on consumers' minds, there's concern over how far the Fed could go with rate cuts while still not being, quote, out of the woods. Now let's dive into the main piece. AI, the winners and losers so far. In February, we covered generative AI in 3 newsletters, and you can access them here. 1. Is the AI rally a bubble? 2. The risks and opportunities across the AI value chain. And 3. Generative AI. Use cases and limitations. At the time, we mentioned that McKinsey & Company identified 6 levels within the AI value chain. 1. Hardware, AI chips, servers, and networking equipment. On level 2, there's cloud platforms, which is cloud providers and the data centers they operate. On level 3, there's the foundational models, the LLMs that power AI applications like OpenAI's GPT-4o and Google's Gemini. On level 4, there's model hubs and machine learning ops, companies that provide tools and platforms to help developers build and manage applications. On level 5, there's applications, the AI-powered applications used by businesses and consumers. This layer is the point of it all. And on layer 6, there's services, consulting and training services to help companies leverage AI. The first 3 layers provide the infrastructure that enables applications to run. Most of the many billions of dollars that have been invested so far have gone into these 3 layers. Building this infrastructure is still very much a work in progress though. Capital expenditure, or Capex, at Microsoft, Meta, Alphabet, and Amazon reached a combined $60 billion in the third quarter. But companies warned that the spending isn't going to end anytime soon. Microsoft said that despite all of its investments in infrastructure, it was struggling to meet demand. Meta raised its Capex target for 2025 to $40 billion. On the positive side, cloud providers are beginning to see increased demand and engagement due to their AI investments. Some are also benefiting from lower costs as they deploy AI tools internally. For example, Alphabet said 25% of its code is now generated by AI. In a recent report, UBS estimated that the current investment phase will continue through 2027 and that AI spending would dwarf general purpose cloud infrastructure. The fact that Capex spending doesn't appear to be slowing down is great news for the companies supplying chips and other hardware to data centers. The likes of Nvidia, Broadcom, AMD, TSMC, and others come to mind here. When it comes to data center suppliers, margins are something to keep in mind. The sector has become a lot more competitive and capacity has increased over the last 2 years. This is less of a problem for Nvidia, which has a very strong competitive advantage. But the companies that supply more generic equipment will struggle to maintain margins. Super Microcomputer, which supplies servers, is now embroiled in an accounting scandal, but its margins were already under pressure before that story broke. So let's talk about the application layer. If generative AI evolves like previous technologies, the application layer is where most of the value will be created. So far, there isn't a lot of evidence that this is happening, yet. But the way cloud providers are pouring billions of dollars into infrastructure suggests they are very confident it's coming. One software company that has struck gold is AppLovin Corp. Its share price is up 500% year to date and earnings per share is $3.42, up from 28 cents a year ago. AppLovin helps developers monetize their apps with targeted advertising via its AI platform. Beyond AppLovin, most companies in the digital ad space are also leveraging generative AI. This is nothing new, as digital ads have always led the way when it comes to monetizing AI. Meta and Alphabet have used AI to optimize the way they target ads to users. Now, they can use new AI tools to help advertisers create ads and to personalize those ads for consumers. Several SaaS companies are also managing to improve engagement with AI, and as mentioned, some seem to be reducing costs and improving productivity. So, while there aren't many examples of, quote, killer apps just yet, many companies are benefiting to some degree. If Microsoft can't keep up with demand, you may be wondering where all that demand is coming from. The answer is that hundreds, if not thousands, of startups and most large companies are building and testing AI-powered apps. One example is Visa, which has deployed 500 generative artificial intelligence applications and continues to build more. If you listen to almost any earnings call, you'll discover that most companies are building and testing apps, both internally and with customers. Some, possibly many, of those apps won't amount to anything, but a couple probably will improve engagement or productivity or reduce costs. Now let's talk about 2025. Will it be the year of the AI agent? If there's going to be a game-changing AI app in the near future, it could come in the form of an AI agent. These are like chatbots or personal assistants that help customers or employees complete or automate tasks. On the consumer side, Amazon and Apple are revamping Alexa and Siri. These personal assistants have generally been a disappointment in the past, but maybe that's all about to change. In the B2B space, Salesforce has launched Agentforce, which allows customers to automate workflow and augment human capabilities. ServiceNow has launched Now Assist with similar capabilities. Chatbots and tools to automate tasks aren't new, but perhaps they are getting to the point where they are powerful enough to be truly impressive. Let's talk about the other winners and losers. Palantir has become a market leader once again. This may have as much to do with increased defense spending as its AI capabilities, as it's always been an AI-focused company. Cybersecurity companies like CrowdStrike also continue to leverage AI, but that's also not new. One group of software companies struggling to leverage AI are the data management apps like Snowflake and MongoDB. Data is a very valuable commodity in the world of AI, but you have to own the data rather than provide the tools to store and manage it. The problem these companies face is that it's a very competitive industry with quite a few competitors, so it might need to consolidate before one or two can thrive. If you're interested in finding more companies finding their stride in this AI boom, be sure to check out the Simply Wall Street Screener. In the article, we have a link to the top US artificial intelligence stocks. You can browse this list or even change the country to find more companies from around the world. So, what's the insight here? Get ready for depreciation to hit a few income statements. The massive infrastructure investments that big tech companies are making are recorded as capital expenditures, or Capex. When these investments are made, they don't show up on the income statement, but they are recorded as assets on the balance sheet. The amounts really just move from the cash section of the balance sheet to the long-term assets section. However, hardware like GPUs and servers are depreciated over the following 5 years. the depreciation charge is recorded as a non-cash expense on the income statement, so it reduces net income. In Q3 last year, for example, Microsoft's total depreciation and amortization expense was $3.9 billion. This year, it was $7.4 billion in Q3. You can see below that depreciation over the last 12 months was around $23 billion, or 25% of its net income. A year ago, that percentage was 18%, and in the recent quarter, it was 31%. As Microsoft and other cloud providers continue to invest in data center capacity, they'll be recording increasing depreciation charges. These charges can be barely noticeable when revenue is rising or when other cost increases are low, but they could have a big impact if revenue growth stagnates. The other side of this coin is that when assets are fully depreciated, they have no more impact on earnings, but they can still provide value to the company. This can lead to a delayed improvement in margins. Capital expenditure is a necessary part of investing in future growth, but it's important to anticipate the effect on earnings. Capex cycles can also create opportunities if the hit to earnings results in lower share prices. This happened to Amazon a few years ago when investments in warehouses hit its margins. And now, in Q3 this year, Amazon reported a record net income margin of 9.65%. Now let's wrap up with the key events during the next week. On Tuesday, UK unemployment is forecast to rise from 4% to 4.1%. On Wednesday, US consumer inflation data will be published. CPI is expected to rise from 2.4% to 2.6%. The core inflation rate is forecast to remain at 3.3%. On Thursday, preliminary estimates for the UK's third quarter GDP will be published. Economists expect year-on-year GDP growth to be 0.6% compared to 0.7% in Q2. US month-on-month producer price inflation data will be published. PPI is also expected to rise slightly from 0% to 0.2%. US initial jobless claims are expected to increase slightly to 225,000. On Friday, Japan's preliminary estimate for Q3 GDP growth is expected to show the economy expanding by 0.3%, down from 0.8% in Q2. US retail sales are expected to show a slight slowdown from 0.4% to 0.3%. Earnings season continues with companies in most sectors reporting, including Home Depot, Walt Disney, Applied Materials, Cisco, Shopify, Spotify, Alibaba, Sea Limited, AstraZeneca, and Occidental Petroleum. That's all for this week's Market Insights. Thank you so much for listening. And until next week, invest well. Simply Wall Street analyst Richard Bowman and Simply Wall Street have no position in any of the companies mentioned. This recording is general in nature. We provide analysis based on historical data and analyst forecasts only, using an unbiased methodology, and our articles are not intended to be financial advice. It does not constitute a recommendation to buy or sell any stock, and does not take into account any of your objectives or your financial situation. We aim to bring you long-term, focused analysis driven by fundamental data.